Okay, good morning then, and I hope everyone's well. Looking forward to the session here, and it's already got going with some pretty decent price action across the assets, really. We've got some, dollar weakness in the mix, leading euro dollar higher. Now have a look at this euro dollar chart quickly before we kind of get into the finer detail here, because the euro is just edging up to have a look at the high we had on the 4th of June last week. So this is at 113.80, and then the price point above there of note is definitely the May high up at 114.72. That's another 92 pips between these levels, so that's a pretty decent distance. But just technically be aware of that we're just about to have a look at the high from last week. Technically as well, on the same theme, the Bund down testing last week's low, again on the 4th of June, 148.87. That's briefly dipping back below the 149 handle. This is looking at the September contract only. If you look at the continuation chart, actually last week the front month contract wasn't the September contract, it was the June contract, and this is the continuation chart. So this is a new low for the front month contract, despite the fact that 148.87 price point has just been tested to the very tick, and we lift a little bit. This is 10-year government bonds in Germany above 1% yield. This is 9-month highs for yields, and it's not just Germany. It's 9-month highs for yields on the long end pretty much across the board, including in the US last night, up above 2.4%. Yesterday saw definitely a yield move again on the long end. All government bonds on the long end yielding higher. It was more of a core Europe move rather than a peripheral, in that core European long end yields rose further than peripheral long end yields. So Italy, Spain and Portugal, for example, their yields went up, but not by much, nowhere near as much as the Bund and T-notes, if you like. So certainly some downside pressure continuing on long duration bonds. We'll get into why in a second. It's not straightforward why, but we'll try and get onto that in a second. Then just again technically looking at some of these equity markets on the top of my screenshot, the S&P sneaking up through the overnight high, which was yesterday's high. This was a key low back on the 5th of June as well. So 2084.75 being taken out technically. We got R1, and then we're looking at 2093 up here. That was the high we had earlier on in the week. That is the high of the week set on Monday. European stocks are lifting. The DAX is testing yesterday afternoon's high. Euro stocks, let me just check, kind of similar. Yesterday afternoon's high just before the European close. It wasn't the high of the day yesterday. Yesterday morning European stocks were higher than this. Interesting, just thinking about correlations, you're actually getting the euro move higher and European equities move higher simultaneously. That's something we haven't seen for quite a while. The negative correlation between those two has been very strong. So it's quite unusual to see this happening, and therefore maybe leads us to believe it's more of a dollar move than anything else. So why is the dollar weakening? And it may be, there's not necessarily any dollar specific news. Yesterday's data out of the US, albeit not headline, not kind of top end significance, but all the data came in better than expected yesterday from the US. So you might think, well, hang on, that should mean dollar strength, but we've got the opposite. Well, maybe it's something to do with Japan. Maybe it's something to do with Kuroda's comments overnight. This is looking at the dollar versus the yen. That's the reverse of what you've got on your CQGs. So what Kuroda said last night, he said that the currency, that's the yen, the currency may not weaken any further on a real effective exchange rate basis. So as he said this, the yen went through a pretty decent phase of strength, and we're still right on the most extreme point of that If I just went to a 5-minute chart quickly, just zoom in on this move, so you can see where he made the comment just after 5 a.m. Steep move to the downside, and when I say steep, I mean 150 pips, pretty much straight off in 20 minutes, and then we've been drifting lower ever since. If you look on the long term, though, you'll see that, I mean, this is a big move to the downside after what has been a huge move to the upside. So maybe it's just this key move on one of the key currency markets, dollar yen, triggering some sort of correlated dollar weakness elsewhere. That's maybe an idea. So I don't think this is particularly, if you're looking at your euro dollar charts, I don't think it's necessarily euro strength here. Although, having said that, the euro is strengthening against the pound, even though the pound is strengthening against the dollar. So, and that's something we've seen as well of late. We have had euro strength over the last couple of weeks, and you've had bond market weaknesses on the long end. And it's confusing when you're thinking about ECB quantitative easing, which has only really just started. It only really got going in March. 60 billion euros a month. They've only really completed 3 full months of that. 3 full months of the 18 months scheduled. So, you know, you're scratching your head a little bit and saying, well, okay, why is the euro able to strengthen? Why are safe haven core European bond markets weakening when you've got the ECB in town with their checkbook plus Greek risk, which is, if anything, escalating? So it's a bit of a confusion. Now, I'm going to bring in a chart, and I've shown you this chart a few times, and this really is what triggered the upside on the euro last week. This is core inflation. Now, with headline inflation, I mean, let's just have a look at headline inflation actually quickly. So headline CPI, look, this is at 0.3% reported last week, which is nothing. You know, this is tiny. This is annualized CPI at 0.3%, a million miles off the 2% target. But the really significant thing here is the trend reversal. This is an undisputed reversal in trend in inflation. Now, if you take this chart further back in time, one sec, let me just take that off and adjust the time. I'm going to go back to like 2010 here. I'll bring this chart back on. This is a reversal in a trend that has been in place for 3 years. This is a long-term inflation trend. If this reversal has happened and is going to continue, then this carries large significance for things like long duration bond yields and the currency's value. Maybe it's not right to be thinking about the ECB's QE program and thinking, well, you know, if this inflation has reversed, maybe we're not going to get the 1.1 trillion euros. Maybe we're not going to get the full package. I mean, I'm not sure about that. I would say at the moment it's more likely we get more than 1.1 trillion than less. So I don't think this is a QE thing. I think this is just an inflation reversal. And if you look at the core inflation, which is more important, you know, a lot of the reason for that headline CPI being down into negative territory is the oil price, and that's stabilized. So we look at core inflation, and if we take that back slightly further in time, let's say go back to 2012, looking at that same downward trend that we had on the headline, well, look, this is a decent pickup. Core inflation is more important to the central bank, I would say, than the headline inflation that's heavily influenced by transitory effects. So, you know, you can't downplay this inflation turn, and because we've got things like the Greek saga dominating the headlines, it's often easy to forget about the more important long-term issues and effects of inflation. You know, the Greek problem, well, I guess that's long-term as well, in that we're 5 years on since the first bailout, but I think ultimately it's the inflation reversal that's shaping a lot of investors' medium-term biases when it comes to particularly core European long-duration yields, as well as the euro's value. So I think this is what's happening. Look at the Bund now, right on 148.87. So this is officially now a new low. I'm going to just take this chart back on a weekly basis. This is a continuation chart. This thing's just collapsed from the above the 160 handle. Just mid-April, just 8 weeks ago, we were above 160. Here we are trading down below 149. Just quite phenomenal. Now, on the downside, the 50% fib retracement of the big sort of 18-month rally here is coming in at 148.56. So this is the next kind of line in the sand on the way down, then the 148 handle, then this key low back in September at 147.63. So bunds yielding above 1%. Who would have possibly predicted that 8 weeks ago? I don't think anybody on the planet would have predicted bunds yielding above 1% in 8 weeks' time, went back in mid-April, but here we are. So pretty interesting. Look, the euro dollar also is just about to test that high from last week as well, 113.80. Now, in the midst of this, we do have the Greek situation to think about. We've got, as I've said, this eurozone reversal in the long-term inflation trend to think about. So let's just talk about Greece. Yesterday's session from an equity point of view certainly helped along initially by the Greek situation. That hasn't improved, and if anything, it's deteriorated. What we've seen yesterday is Greece submit another revised proposal. It's just that Greece, there was quite a good piece in the FT this morning on this, in that it looks like Greece are playing the game. It looks like Varoufakis is all over this strategy with his game theory expertise, but it does look like Greece are just now delaying again because they understand the situation to be that the only way Europe are going to make concessions on the deal and make it palatable for the Greek government and the Greek people is if they take this right to the very, very final moment, and as you're teetering on the brink of a Greek default and a Greek exit, Europe cave in and Greece get the deal they want. And so what happened yesterday was Greece really stepped away from a deal by introducing a new proposal that, yes, they had a concession in which case, by which I mean they upped their primary surplus target, but they didn't say how they would achieve that higher primary surplus. And actually at the same time they introduced a new document to the proposal, which was a debt relief document, which is it's just like rubbing salt into the wound, really. The idea that Greece are now looking to negotiate a long-term debt relief before they've negotiated and done a deal on short-term funding, that's completely backwards. First they need to sort out the short-term funding and avoid default, then and only then can they start to turn their attention to long-term debt relief. The Bund has had a really good breakout here. That's 20 ticks through last week's low, 148.87 breached. 20 ticks down. We're now almost at that 50% fib level I just mentioned. So nice strip out in the Bund here. So it continues to be a market space dominated by this remarkable move in long duration yields. But Greece have stepped away from a deal. They're now further away from a deal, to the point where we've got EU leaders meeting in Brussels today. It happens to be a Latin America conference, but the idea was that on the sidelines of this conference we'd get Tsipras meeting with Merkel and Hollande, and perhaps progress could be made. Well, there's actually a risk this meeting's going to be cancelled, given the proposals Greece introduced yesterday, and now you're getting equities push a little bit higher. But given the proposal Greece introduced yesterday, it may well be that the European leaders say, look, forget it, there's no point having a meeting. If they're going to mess about like this, we're not interested. The main thing is, I think, if Greece are playing that game, that strategy, I think they've got it spectacularly wrong. I think they get to the brink, they then try and force Europe's hand to make concessions, and I don't think Europe are going to. I think they're playing a dangerous game and they're going to lose it if this strategy is the way they're going to go, I think we have a Greek default by the end of the month. So this is a risk that's on the table, but it's not a risk that's really playing out in any market in any meaningful way. And that also, I think, strengthens Europe's hand. If financial markets are quite nonchalant about a Greek exit, well then maybe a Greek exit isn't that big a risk to the Eurozone system and the Eurozone economy, especially when you've got the ECB safety net in place. It's a huge monster risk for the Greek economy, but I think Europe are quite, relatively unconcerned. And there was another piece in the FT this morning about how much time have European leaders, and let's say Merkel, heading up the biggest economy in Europe, how much time has she spent in the last 5 years trying to sort out Greece? This has, I think, been to the huge detriment of the Eurozone as a whole, in that Greece is 1.8% of the Eurozone economy, 1.8%. Now, they made a great comparison. Would Barack Obama be willing to spend a similar amount of time on Tennessee? Tennessee, the state of Tennessee, is the equivalent size of Greece. Tennessee is the equivalent size in the US economy to what Greece is to the Eurozone, and it's just dominated EU summits for 5 years. This is completely distracted them and taken their eye off the ball. You know, when you think about issues on, I don't know, things like, Russia and the terrorist threats, if you think about things like, I don't know, even immigrants trying to cross the Mediterranean, if you think about major reforms being made to make the Eurozone more competitive in an environment where you've got giant emerging economies like China and India snapping at their heels and winning market share in terms of the global economy, and here you've got the Eurozone, no growth for 5 years and completely sidetracked by trying to sort out an economy that's just 1.8% of the system. So anyway, these are issues that you can think of. But right here, right now, we've got the euro trying to push to test last week's high. The Bund is leading everything still, dragging the T-notes lower as well. Continuation of the just extreme move to the downside. And as it stands, you've got stocks trying to reverse what's been a week-long downtrend. Let's just have a look at the S&P. This has been trending lower quite nicely, pretty much for the whole month. Yesterday, the low point we got to, 2068, actually puts us, if I go to a yearly chart, puts us flat on the year yesterday. Well, not quite. Flat on the year is 2054. We got to 2068 yesterday, almost back to 0% return on the year. I know we've lifted now. But go back to the 1 hour chart. We've got a quite messy but trend reversal signal yesterday, and it was definitely a day of two halves. We definitely got some downside momentum in the morning. We got some decent momentum to the downside in the afternoon as well. But ultimately, it tracked back higher and we reversed. So we do have this. R1 is key resistance that's just been tested. But I still think, I'm still in the bearish camp. If you think about the daily chart here on the S&P, we're back up to test the underside of this trend line that I had in place. I think we are still bearish. I think this is a temporary pullback. And I think the Greek risk, as much as anything else, will prevent a strong rebound here. Let's have a look at the calendar for the session ahead. Here we go. Not much on the slate. We've got some UK data this morning at 9:30. UK industrial production and manufacturing production. So we're expecting 0.1% growth on both. And then that's it, really. I mean, it's a rubbish day for data. We've got the Department of Energy numbers at 3:30, and we're expecting another drawdown, 1.45 million barrels. Let me just finish on the calendar. Actually, hang on a sec. Let me just pull this down and see. We've got this summit perhaps the summit in Brussels is the main point of attention, with potentially a meeting between Hollande, Merkel and Tsipras, but as it stands there's uncertainty whether that's going to happen. What's interesting tonight, we've got Carney and Osborne talking at Mansion House, and it's looking likely that Osborne's going to steal the headlines. He wants to try and put into law the situation where it's illegal for the UK government to increase its deficit during periods of economic growth. So in good times, don't borrow more like Labour did. Readdress and sort out the fiscal situation. In good times, reduce deficit, but in bad times, sure, increase it and introduce fiscal stimulus. This is a speech that's going to dominate the headlines tomorrow morning. What's interesting this morning, actually, 10 o'clock, Greek T-bill auction, 2.25 billion euros, 6-month T-bills. You might think, wow, who's going to buy that? You know, if we've got a Greek default risk in 3 weeks, who's going to buy 6-month T-bills? Well, I'll tell you who. Well, actually, you tell me. Who's going to buy Greek 6-month T-bills today, this morning? Who's going to want to take on that risk? Anybody know? In the main room, correct. In the live room, Andrew, correct. And Will in the new room now, thanks. It's the Greek banks. Don't worry about this auction. They will sell 2.25 billion euros. How? The Greek banks will buy it. How will they buy it? Well, they're getting funded by the ECB. So this ridiculous, I'll say it again, ridiculous situation continues. So that's something perhaps of interest. We get German Schatz auction today. That's a 2-year government bond, 2017 duration. That has implications for the Bund. Not massive, but that's something else to look out for at 10:30, okay? Alright, let's get on with it then. Bund testing the 50% fib. 148.56. What have we got on the low here? 148.52. Yeah, so the Bund is testing the 50% fib of its 18-month rally after another steep sell-off to get the ball rolling on the day's session. Okay, guys, enjoy the rest of the day.